number one, this has been like my favorite website or platform to go to, called Simply Wall Street. So what you can do is you can load your portfolio that you have on EasyEquities onto Simply Wall Street. What it allows you to do is you get to see the best performing shares, ETFs, best performing crypto on the app. So you get to see the performance of the stocks. And at the beginning of my journey, I would just invest. Right. So I just invested in these companies that I believed in, these ETFs that I had researched on, and I believed that they would do really well on the stock market, right? So after I set these companies and I was set on them, I said that in the year 2023 that I wouldn't buy any more ETFs or any more stocks, and I'd actually work on building that particular portfolio instead of adding more and more ETFs, right? So what I would basically do is I would log on to my portfolio and then I would check which stocks, ETFs, equities, crypto, whatever it was, which one of them was an undervalued. So if it said 20% or 50% undervalued, then I would buy more shares into it. What it means when the stock is undervalued means right now it's 20% lower than what it normally is, right? So that's what I would do. So Simply Wall Street is the app. You get tons and tons of features on the app that can help you on your stocks journey. And number two is buying the dip. I am so glad that when I noticed that my EC10 stock had gone down, it was down like 60% at some time. I kept on buying and buying and buying and buying the dip, right? I'm buying the dip, and I'm so glad I did that instead of like just selling and giving up on that on EC10, because now it has gone like is it on 200% profit? It has gone up to like it's above 200% now, and I'm so glad that I bought that dip. So if there's a stock, if there's an ETF or an equity or cryptocurrency that you believe in, even when it goes down, as long as you believe in it, buy the dip, buy the dip, buy the dip. Because I assume that you invested in that particular stock because you noticed or you felt that it would do well in the long run, right? So if you have that, if you believe and you really believe in that stock, buy it, buy the dip. Do not be afraid. If it goes down, it'll push you for you to go and buy that dip, right? Push for you to go down and buy the dip. And I'm so glad I did that. So number two, definitely buy the dip. Do not be afraid to buy the dip. Take the risk, buy it. Number three is invest to sell or for dividends. What do I mean by this? When I started my buying stocks or buying shares journey, I just knew that we were buying stocks because they're going to make us money. That's all I knew. And I like money. So I was like, I'm just going to do this. I'm going to make money. Somebody had posted that they get 1,000 dividends every month or like every quarter from this particular ETF or stock. And I was like, I'm buying it. I want to get that money as well. Right? Somebody had posted that this is how much this was CapTech was this much, was 3 rand when it started, now it's on like 1,006, and this is how much that portfolio is, and I'm like, I'm buying CapTech, right? But the one thing that I wish I knew or I had done more research on is why I am actually buying or why I'm going into stocks and which stocks work well with my investment timeline, right? So some people buy shares because they want to make a living or get money from dividends. So that person will purchase maybe Exaro because they know that Exaro has high dividend payout. And then they know that every month or every quarter or whatever time that Exaro pays out, that they'll be getting this much dividends from the place, right? So if you're going to be buying stocks, just know that this one I'm buying it because I want dividends. I want dividends from this one. And in the long run, obviously, if the company is also doing well, you can make money from that company when you decide to sell. Number two is know which shares you're buying to sell. Know which ones you're buying to sell, because some of these shares, they do not have dividends. Not all of the shares that you buy on EasyEquities will have dividends. So know which stocks have dividends. Know which ones have dividends, know which ones you're just buying so that you can sell them in the future when they've made a lot of money, right? Just like how people are buying crypto now, because in the future we are estimating that it's going to make us a lot of money, right? So in the beginning, set aside time and decide on whether you're going to be a long-term investor, which means you want to buy now, and then in 10 years from now, that stock would have gone up, and you get to sell it and you make money from that stock, right? You get to sell it for the profit of it, depending on how you want to sell it, right? Or you simply say, well, I want to make dividends, so I'm going to buy this and this and this company because it has dividends, and I'm going to solely focus on these ones, getting these ones, investing more money into these ones so I can get dividends from them. Number 4 is deposit every month. Set a reminder if you can for your deposits. I personally have I've created an invest group chat. I'll call it a stokvel, an invest stokvel, where we simply, if it's your turn and it's your month, where we send money to you. Typically, like a stokvel, when it's your month, we send you money to your account, right? But with this one, we send money into your EasyEquities account, right? So this helps me to remember that, okay, I've sent money to Yolanda, so let me also add this much. All right, so when I'm sending Yolanda that amount of money, I'm also depositing money into my EasyEquities account. So that's my reminder, right? And then also, it is definitely great to have a stokvel with a couple of friends who are also interested in going through the same journey and investing, so that they hold you accountable, right? And the best part is when it's your month, also you get to buy more stocks that you invest regularly. The reason why I'm also saying this is because sometimes maybe you'll say, no, I'll invest January, and then I'll invest again in maybe June, and then maybe sometime in December. The share price is changing. It's fluctuating every month, every day, every second, every minute. The share price is fluctuating. So this month you might find that this particular share is undervalued at like 20%. And then next month it's like 60%. So you lose out on the month where the share was undervalued for like 60% if you not invest regularly. Overseas account, invest in those. Invest in those. When I started, I was focusing on my Zara account because I was doing research, and I would find a lot of YouTubers saying buy Kumba oil, buy Sasol, buy this, buy that, and I was investing a lot into those companies, right? But when I finally got comfortable, I started investing in Australian shares, then investing in American shares. And right now, my Zara account has more shares bought, more money invested into I've invested more money into my Zara account than my USD account. But my USD account has a higher profit margin than my Zara account. So I've bought, like, American shares, your Teslas. I've bought some REIT ETFs in there. That are a few that I found and I was doing research on. And my USD account is performing way better than my Zara account, and my Zara account has more money in it. So I wish in the beginning I had actually had the courage, or knew that I could invest in offshore accounts, like an open offshore account like my USD and Australian market account. When I started investing in EasyEquities, I didn't know what people meant when they kept on saying TFSA account. I didn't understand what they meant. I heard them saying that, no, guys, invest in a tax-free savings account. Yeah, da 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 da. You'll be doing this. You'll be doing. I didn't even hear what they were saying because of the terms, I guess, that we use in tax-free savings account or whatever it is. I didn't even know what tax-free savings account meant. I didn't even know what it meant. And now that I've been investing longer, I literally sit down every month, and before I invest in shares and I go on Simply Wall Street, what I'll do is I'll check how much the brokerage fees were, how much dividends I got, how much they were, and what were the fees that I paid, and all of that. And during that, we notice that I'm not being charged any tax on my tax-free savings account. It's literally self-explanatory. Tax-free savings account. Guys, I wish financial literacy was taught in schools. I really wish it was taught in school. I never understood what tax-free savings account meant. Every time that you deposit money to buy shares into your account, you're going to be charged capital gain interest. I hope I'm saying it correctly. I might be wrong. You're going to be charged interest on your, you're going to be charged interest. You're going to be charged tax on the interest that you've gained in that account. You're going to literally be taxed on the money that you've made. So even if it's in the bank and you're saving, they're going to still charge you tax on that interest that you've gotten in that account. So what the tax-free savings account does is, when SARS comes trying to charge you tax on that account, or interest on the money that you've made, it's like, whoa, like, wait, you don't get taxed at all. I knew that it meant that that account that I'm opening, I'm not going to be charged any tax. Nobody's going to be taking any money out of my interest that I've earned from that money. And uh, I can't really say that we have not explained it, or people or whoever I've watched them not explain it in greater terms, but I wish I understood the terms when I understood what they were saying when they were explaining what tax-free savings account was then. And I wish I understood when they kept on saying, no, you have a threshold of 500k your entire life. So in your entire life, you have 500k that they're saying, on this 500k, we're not going to charge you any tax on the money that you've made. You can max it out by investing 36k a year in your tax-free savings account. Where I am now, I really do wish I took the time to, I focused on my tax-free savings account more than I did on my Zara account when I started investing on EasyEquities. Popular to contrary belief, or whatever they say. Popular to that. I know a lot of people say do not buy crypto. I wish I hadn't been scared to buy crypto. Guys, the manner in which crypto is going up, like the manner in which crypto is going up, I've noticed a Bitcoin ATM for Rosebank Mall. A Bitcoin ATM in Rosebank Mall. So this crypto thing is real, like it's really real. And then there's a time where Pick and Pay said we can now use our currencies to purchase from them. I was like, I'm buying more crypto shares. And it is the best decision I made. My crypto account right now, I know in the previous video I'd only bought EC10, but I added other cryptocurrencies, and I do not regret it. The only regret I have is having not invested in crypto a long time ago. I'm glad I bought the dip when I noticed that crypto was. I'm glad. While we're on that crypto issue, another commodity that people buy is gold. Buy it. Research. Research. There's never going to be a time where you have researched enough when it comes to buying shares. If it means following people who post regularly on shares, follow them, Instagram, Twitter, TikTok, YouTube. It means following those people and sitting like this with a pen and paper to hear what they have to say. Sit there and listen. Research. Research. If it means buying another stock because you want to buy another stock, do it. Another problem that I had in the beginning is I wouldn't say I did my own research. I don't know if I can call watching YouTube videos research. What I did in the beginning. In the beginning, I sit down, I had a pen and paper, I went through YouTube videos on what EasyEquities is, which stocks are performing well, which stocks to buy, which stocks YouTubers were saying are crypto, which stocks um, uh, YouTubers were saying I should buy, and those were the stocks that I bought. And I was looking at their portfolios, and I was like, okay, let me buy this stock. This one is performing well. This one is performing. Some of those stocks till date, I don't know what they are. Some of them are performing really well. Some of them I had to sell. Is one that I sold. I will not blame it on any YouTuber. That one I bought it because I was working for a lubricant company and I saw the amount of oil that was going out each day, and I figured it would be a great investment and I bought it. Right, that was one. Number two, there was a stock that was suggested by a YouTuber that I bought. I'm not sure if I'm saying it correctly. It's like Avenge. I don't know what it is. Avenge. I think it's called Avenge. I might be wrong. But since I bought it, I can't wait for the day. Even if it says one red profit, I sell that thing. I sell it. It hasn't been performing well since Kireka. Since I bought it, and it's been 3 years now. This is what I would advise. Whatever place that it is that you regularly buy at, write them down. And then try to go and find out which companies these fall under. And those are the companies that you can say, okay, I know these companies and I believe in them and I regularly shop in them, so let me buy them. Then once you've done that, only then can you then say, okay, let me go research other stocks that might be out there that I don't know about. I wish that's what I did in the beginning instead of just buying whatever people were saying is good. What people were saying is a good stock. I wish I had done that in the beginning. If you are still a baby investor, right? You're still a baby investor and you're a little scared about buying shares, I would advise you to buy ETFs. So what ETFs are, it's just like a bucket, like a bucket, like a bucket. Let's say you have a bucket and they've put all these eggs. Maybe they put these eggs in the basket. So each egg represents a company. So it makes it easier when it's an ETF because if one egg is not performing well and the other four eggs are performing well, you're still safe. If two are not performing well, three are performing well, you're safe, right? If three from four are not performing well, two are performing well, you're safe. Other than if it's just one company that's not performing well, and then you know. So ETFs are a really good safety net. So if you're still starting off and you're a bit afraid, buy ETFs. Easy properties. I am not sure if I like them or I don't like these properties. I have not withdrawn anything yet. I've been getting dividends from the properties I invested in. And with easy properties, you're gonna have to wait. It's a long run with easy properties. It works slightly like real estate, like literally real estate, where you buy a property today and in 10 years it might be worth this value and you can sell the shares at that much. Don't buy a property if you want to sell in 5 years. On easy equities, you might just end up selling it at the same amount as when you bought it for real. So I'm still 50-50 on whether easy properties might be a good investment, but I have not, since I bought easy property these shares, I have not withdrawn anything. Draw in the next whatever years it is, and I will not purchase again. I think for me, easy properties was a great way, was a great way for me to get into real estate because I'm doing Airbnb now. It's taught me a lot on properties and how property works. So we're estimating that this property that we're investing in today is going to yield the rental income of this much, and in the next 10-20 years that it will be worth, if we had it established for like if we developed it for like 1 million, that in the next 20 years it will be sold at 50 million and we would have made money from it. So it really helped me to get into real estate and understand the property market. But given the chance, I would not buy any easy property shares again. Thank you for watching and hope to see you in the next video.